For decades, every major Federal Reserve easing cycle has changed the direction of global capital flows. And whenever the Federal Reserve shifts from tightening policy toward easier monetary conditions, hard assets historically begin outperforming paper-based investments because the modern financial system depends heavily on liquidity and low borrowing costs to sustain growth. While high interest rates slow consumer spending, weaken housing activity, tighten credit markets, and increase debt servicing pressure across the economy. And this is the exact environment now developing in the United States, where inflation remains elevated, consumer debt continues rising, government deficits are expanding rapidly, and commercial real estate pressure keeps intensifying while the Federal Reserve faces a difficult choice. Because keeping rates high for too long threatens financial stability, but reducing rates too early risks another inflation surge. And historically, central banks trapped between economic weakness and rising debt burdens usually choose monetary easing over prolonged deflation, which becomes extremely important for silver. Because silver functions both as a monetary asset and an industrial metal, unlike most commodities, since solar panels, electric vehicles, semiconductors, and advanced electronics all require significant amounts of silver, while physical supply growth remains limited because mining production has slowed or grades continue declining, and new projects require years of investment, creating tightening supply conditions during a period of expanding industrial demand. And historically, silver has delivered explosive price movements whenever monetary confidence weakens, as seen during the inflationary cycle of the 1970s, when investors rushed toward hard assets after fiat purchasing power deteriorated, and today several similar warning signs are appearing again. Because global debt levels continue reaching records, interest payments on United States debt are climbing rapidly, geopolitical instability remains elevated, and central banks worldwide continue increasing gold reserves, which signals declining confidence in long-term currency stability. While ordinary Americans are already feeling the effects of persistent inflation through higher food prices, rising insurance costs, expensive housing, and record credit card balances, forcing many households to rely more heavily on debt simply to maintain living standards. And this environment gradually pushes investors toward assets capable of preserving purchasing power during periods of monetary uncertainty, while silver increasingly fits that role because both institutional and retail investors are beginning to pay closer attention to precious metals markets as expectations grow that the Federal Reserve may eventually pivot toward easier policy conditions, and markets rarely wait for official confirmation before repricing assets, which is why silver could become one of the most important beneficiaries of the next major monetary shift. As financial markets increasingly anticipate a Federal Reserve pivot, investors are beginning to recognize that silver may be entering the early stages of a major revaluation cycle, because every significant period of monetary easing in modern history has eventually weakened fiat purchasing power while strengthening demand for hard assets, and the current economic environment contains many of the same conditions that previously fueled powerful precious metals. Rallies, including excessive government debt, slowing economic growth, persistent inflation pressure, and weakening confidence in long-term fiscal stability, while the United States government continues issuing enormous amounts of debt at a pace that becomes increasingly difficult to sustain under high interest rates, because rising borrowing costs dramatically increase federal interest payments and place additional strain on the financial system. While consumers across America are already experiencing higher living costs, rising credit card balances, and reduced purchasing power, which signals that economic pressure remains deeply embedded beneath headline statistics, and historically, when debt burdens rise while growth weakens. Central banks eventually respond through easier monetary policy, lower interest rates, or additional liquidity support designed to stabilize markets and maintain confidence. And these actions usually weaken currency value over time, which benefits scarce hard assets like silver, because silver has traditionally functioned as both an inflation hedge and a monetary alternative during periods of financial uncertainty, while, unlike gold, silver also benefits from strong industrial demand. Since solar panels, electric vehicles, semiconductor technology, and advanced electronics all require large quantities of silver, and global industrial demand continues expanding, even as physical supply growth remains limited, because mining production faces declining ore grades, rising operational costs, and long development timelines for new projects, creating tightening market conditions during a period of growing consumption. While many investors underestimate how small the silver market remains, compared with stock markets, bond markets, and currency markets, meaning even a modest increase in institutional investment demand could create substantial price acceleration, because available supply cannot quickly expand in response to sudden buying pressure. And this dynamic becomes even more important during periods of monetary instability when investors seek protection against inflation, currency debasement, and broader systemic risk. while central banks around the world continue increasing gold reserves, which reflects declining confidence in long-term fiat stability. And although silver receives less attention than gold, it has historically delivered larger percentage gains during major precious metals. Bull markets, because silver markets are smaller, more volatile, and highly sensitive to investor sentiment shifts, meaning a Federal Reserve pivot combined with persistent inflation and rising investment demand could create the conditions for a powerful silver rally in the years ahead. The possibility of silver reaching $150 before Christmas may sound unrealistic to many investors, yet financial history repeatedly shows that extraordinary monetary conditions often produce extraordinary market reactions, because major asset repricing cycles usually begin while most market participants still believe current conditions are temporary. And today, the global economy faces mounting pressure from record government debt, persistent inflation, slowing growth, fragile banking stability, and declining purchasing power, while the Federal Reserve remains trapped between controlling inflation and preventing financial instability. Because maintaining high interest rates for too long places enormous pressure on consumers, businesses, housing markets, and government finances, especially as debt servicing costs continue rising across the economy. And historically, when central banks confront this situation, they eventually choose easier monetary policy, lower rates, or additional liquidity support in order to stabilize markets and protect economic growth. And those actions often weaken currency purchasing power over time, which benefits hard assets like silver. Because silver has historically functioned as both a monetary hedge and an industrial commodity during periods of financial uncertainty, while, unlike gold, silver also benefits from strong industrial demand, since solar energy systems, electric vehicles, semiconductor manufacturing, medical technology, and advanced electronics all require substantial silver usage. And this demand continues expanding globally, even as supply growth remains constrained because mining production faces rising costs, declining ore grades, and limited discovery of major new deposits, creating tightening market conditions during a period of increasing consumption. While many investors underestimate how small the physical silver market actually is compared with global stock and bond markets, meaning even a modest increase in institutional investment demand could create significant price acceleration because available supply cannot rapidly expand to meet sudden buying pressure, and this becomes even more important if the Federal Reserve officially pivots toward easier monetary policy, because investors historically move towards scarce tangible assets whenever confidence in fiat purchasing power weakens, while ordinary Americans are already experiencing the long-term effects of inflation through higher food prices, expensive housing, rising insurance costs, and record credit card balances, which gradually pushes both retail and institutional investors toward assets capable of preserving value during periods of economic instability. And although silver receives less mainstream attention than gold, it has historically delivered larger percentage gains during major precious metals. Bull markets, because silver markets are more volatile and highly sensitive to shifts in investor psychology, meaning a Federal Reserve pivot combined with persistent inflation, rising industrial demand, and tightening physical supply could create the conditions for a powerful silver rally that surprises financial markets with both its speed and magnitude.